Hello, a warm welcome to all international investors.
In this video, I explain 4 powerful measures every value investor should know: earnings yield, free cash flow yield, dividend quality, and total return. These metrics help you understand the true return you receive as a shareholder. Earnings yield is the inverse of the PE ratio. Instead of asking how expensive is the stock, it asks how much earnings do I receive for every rupee or dollar I invest. How it's calculated is simple. Earnings yield equals earnings per share divided by share price, or 1 divided by the PE ratio. For value investors, this is far more intuitive than using the PE ratio because it shows the return you are getting on every rupee or dollar invested. A high earnings yield means you are getting strong earnings relative to the price you're paying. A low earnings yield means the business is expensive relative to its earnings. Earnings yield also allows direct comparison to government bond yields, corporate bond yields, real estate yields, and other investment alternatives. This helps value investors decide whether a stock offers a better return on capital than safer or competing assets. When combined with FCF yield and ROIC, earnings yield becomes a powerful way to judge whether the company is undervalued or overpriced relative to its true earning ability. Free cash flow yield measures how much free cash flow the company generates compared to its market price. It is one of the most important valuation metrics for value investors because free cash flow represents real distributable money. How it's calculated is simple. FCF yield equals free cash flow divided by market capitalization. A high FCF yield often signals undervaluation and a strong margin of safety. A medium FCF yield usually means fair value for a stable compounder. A low FCF yield suggests the stock is expensive and depends heavily on future growth to justify the price. Unlike earnings, free cash flow cannot be easily manipulated, represents real economic value, and reflects how much cash the business actually produces. For value investors, FCF yield is one of the clearest indicators of intrinsic value. Dividend yield tells you how much cash return you receive each year relative to the stock price. How it's calculated is simple. Dividend yield equals annual dividend per share divided by share price. A high dividend yield can be attractive, but only if the business model is stable and the dividends are sustainable. A low dividend yield can still be acceptable when the company reinvests cash at high ROIC. Value investors focus on quality of dividends, not just the number. The payout ratio shows how much of the company's earnings are paid out to shareholders. How it's calculated is simple. Payout ratio equals dividends per share divided by earnings per share. A low payout ratio gives the company room to grow dividends. A moderate payout suits stable, predictable businesses. A high payout ratio can be risky if earnings fall. Value investors prefer stable and sustainable payouts. Dividend growth shows how consistently a company increases its dividends over time. Value investors look for patterns instead of single year increases. Dividend growth is observed by comparing this year's dividend to last year, the average increase over 3 years, the average increase over 5 years, and checking whether management increases dividends even during tough years. Strong dividend growth means durable cash flow, confidence by management, long term financial strength, and shareholder friendly policies. A company that grows dividends consistently is usually stable, well managed, and predictable. Total return includes stock price growth and dividends. It measures the real growth of an investment over time and captures the full effect of owning the business as a shareholder. The simple explanation is this: total return is the percentage growth of your entire investment after accounting for both price increases and dividends. This is the most complete measure of long term shareholder wealth creation. Here is what each time period tells a value investor. A 1-year return shows short-term trend, but it's not reliable for deep conclusions. A 3-year return shows medium-term stability and business momentum. A 5-year return reflects performance across a typical business cycle. A 10-year return shows the company's long-term quality, resilience, and consistency. A 15-year return is the gold standard for value investors. It reveals whether the business compounded wealth through recessions, market crashes, and expansions. A company with strong 10 to 15-year total returns is almost always durable, well managed, cash generative, and protected by a strong moat. This is exactly the type of business long term value investors want to own. These metrics help value investors understand earnings power, cash flow, dividend quality, and long term compounding. Thank you for watching.
Please do subscribe and stay tuned. See you next time.